Much wow. Some of the world's most popular companies are in free fall, and the stock market in general is not doing good because Apple down 11%, Tesla down 25.7%, NIO down 36%. This is causing some people to think that we're in the beginning stages of the worst market crash that we've seen since 1929. But let's be real, no one's ever actually seen the crash of 29 unless they're like 92 years old, and let's face it, most 90-year-olds are probably not watching my YouTube videos, and if they are, welcome. So in today's video, I wanna make sense of exactly what is going on, and then I'll show you exactly what I'm buying, because you're gonna hear things like bond yield increases, the end of the super long-term debt cycle, and I wanna make sense of what that means. And hopefully this gives you some insight, but at the end of the day, anyone can make a prediction about the market crashing, and eventually they'll be right. The trick is knowing exactly when it will happen and what will cause it to happen within a reasonable time frame. And to my knowledge, no one's ever been able to consistently do that. So save yourself the money and don't pay for newsletters and don't watch YouTube videos. I'm just kidding. Don't do that last part or I'll starve. Let's talk about it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the stock market crash. So let's understand exactly what is going on. This is a theory that you're gonna hear about a lot, if not right now, in the very near future from companies and hedge fund managers anytime we see this headline of the stock market is crashing. And it sounds really scary, and it kind of is, but you should still understand exactly what it is. It's called the super debt cycle. And this happens once every roughly 50 to 75 years. And apparently we're at the end of one right now. But what is the super debt cycle? Hi, Andre. Reuse jokes here. So here's what it really means. Imagine the economy represented by a huge complicated equation with a lot of different variables that economists are still trying to figure out. But we do know that some of those variables include things like productivity, which is measured in GDP, or the gross domestic product. Another variable is the national debt, which historically right now is at an all-time high. We know it's things like interest rates, which are historically at an all-time low. But one of the variables that central banks have control over right now is obviously the cost to borrow money. By lowering the interest rates, you help the economy grow because it encourages people to go out there and borrow money to buy assets like stocks and real estate, and it encourages consumer spending. That makes sense. But there is a limit to how far you can decrease the interest rate before you lose control over that variable and it no longer has any effect on the economy. When you combine that with a couple other things, it is said that we are nearing the end of a long-term or super debt cycle. And here's what that really means. Now, Ray Dalio is really the best person to explain this, but the last time that we had the end of the super debt cycle was after the Second World War in 1945, when we signed the Bretton Woods Agreement, and we basically created a whole new monetary system where we said to the world, "Hi world, you see this dollar? It's about to become the new world reserve currency for everybody else. What's up? Oh, you don't like it? It'd be a shame if someone found oil in your country." And so imagine these booms and busts. The last times were 2008 and 2020, which are some of the more recent ones. But if you could zoom out and look at the last 50 years, you could see these short-term debt cycles play out where we have booms and then crashes and booms and crashes. But on the whole, the trend line is upward. That is the long-term debt cycle. But they don't always go up. At some point, they have to come back down, and that marks the end of a long-term debt cycle, which usually marks the beginning of a new type of credit system. And here's where the real worry is. Investors are worried that central banks, aka Papa Powell, have lost control over helping the economy grow by just lowering the interest rates alone with their monetary policy that's loose like sleeve of wizard. Because remember, those techniques have limitations, and quantitative easing, aka infinite money glitch, aka money printer go no longer have any effect. So we have to find different techniques of helping the economy grow and fight the inflation from what happened in 2020 and potentially this year as well. And that's where this potential fear over a tightening of monetary policy begins, because a tighter monetary policy means higher interest rates, which tends to increase the rates of bonds, which scares people away from the stock market, and it begins to fall. So all of this growth that's been fueled by monetary expansion for decades and decades makes people believe that at some point this long-term debt cycle has to come to an end and the debt must be repaid. It's a movie quote from somewhere, I don't know from where. So as investors in the markets, we have to look at what's called the risk premia. But what is risk premia? Just kidding. I won't go there again. Here's what it means. So risk premium or risk premia is just a fancy way of explaining that we as investors have to make a financial decision when we invest in risky assets versus non-risky ones and then weigh that over their returns. So for example, if we hold an asset like a stock, we have to weigh the return of that stock versus holding a non-risky asset like cash. So basically, it's the minimum amount of return on investment that we need in order to take the risk in the first place. So if I had known that buying Logan Paul's Pokemon pack, which would have given me an NFT that would go on to be worth something like $40,000, I would have bought the Pokemon pack because that's like getting it for free. And that's a risk premia that I can get behind. And so this is where bonds come in because investors are afraid that bonds can signal the start of a market crash. And here's a really simple way of explaining why investors are afraid of this. Bonds are a lot less risky than stocks. So imagine this scenario. What if I was to offer you $100 right now? You could take it right now, or you could risk that same $100 for a 50-50 chance to win $1,000. Now think about that, but here's another scenario. What if I was to give you a guaranteed $500, which you could risk for a 50-50 chance to win that same $1,000? Does that change your decision? For most people, they would probably take the risk of the $100 turning into $1,000 because that's a tenfold increase over a pretty good odds. But what if I was to offer you the guaranteed $500? A lot of people would not risk that. They would rather take a guaranteed return on their money. And that's a really simple way of understanding why rising bond yields would actually hurt the stock market. Because why would you risk to get $1,000 when you can get a guaranteed $500? So rising yields means incentivizing people to go from more risk down to less risk. Now, my philosophy is that when it comes to bonds, they don't really create any wealth. And for that reason, I'm out. Unless, of course, you're already in retirement and you want to just preserve your wealth, then I'd buy a bunch of bonds, but only if the yield hits something like 3, but hopefully closer to 4%. Because I think it's better to invest your money on a guaranteed rate of return of even something like 4% rather than risk it in the stock market for maybe 7%, but maybe negative 20%. So that's what I would do. And then I'd stick that into my Roth IRA account where I don't have to pay any taxes on that income and I'm set. But we are years and years away before bond yields hit anywhere near 4%. But bond yields are going up. And the reason for that is because, number one, vaccinations are way ahead of schedule. And number two, we're expecting this new $2 trillion stimulus package to go through, which creates this perfect scenario of expectations of inflation, which has created this scenario where the Federal Reserve is selling off their bonds, which has decreased their value but increased their yield. Because remember, it's an inverse correlation between price and yield. And that puts a downward momentum on companies, aka stocks, from borrowing money, because then it becomes more expensive to borrow money, which limits their growth, and that's why the stock market is falling. But that's the technical explanation. So now let's get into the fun stuff and actually use this and apply this knowledge, and I'll show you what I'm buying. First, I never let market conditions tell me how to invest my money. So what I find the most fascinating about the end of this long-term debt cycle, which sounds terrifying, is that economists have been talking about it for so many years. This is not the first time. And I'm sure that at some point, some economist will come along and predict it accurately, and then he or she will be called the genius of our time, which is also why I'm making this video, so that I can take credit for it later, leverage it to sell you some courses. I'm just kidding. The most fascinating thing is that this long-term debt cycle narrative sort of lines up with what we've seen in the cryptocurrency space this year. Because remember, the end of a long-term debt cycle usually means the creation of a new credit system. And I can totally see how in the near future, we're going to change the credit system and be able to borrow money not from banks like we do today, but perhaps we'll crowdsource or crowdfund our debt to somebody else, like a blockchain company or a crypto company or what have you. Now, even though I am one of the biggest crypto believers that you'll probably ever meet if you watch any of my videos, I'm still gonna take the devil's advocate approach and tell you this. When I initially invested $100,000 into my cryptocurrency portfolio, it became worth roughly 25 to 30% of my net worth, which is awesome. And I could sit here and tell you I'm a genius, I knew it all along, and then leverage it to sell you some products. But the truth is, this could have gone in the complete opposite direction, and it still can. So I've learned my lesson. Don't get too excited.
You're not a Jedi yet.
But even though I have every reason to sit here and tell you that you should move your money away from the stock market and into the future with cryptocurrency, the truth is I would never tell anyone that. I don't believe that at all, because even though the technology is there, and even though I fully believe that blockchain and cryptocurrency will be the new credit system in the future, that's inevitable. The truth is we are so far away from that point. The regulatory system, the justice system, the legal system is so very far away from understanding what smart contracts are, let alone writing rules, code, and regulation to support these ideas. So I guess what I'm saying is, even though the stock market looks as though it's set up to drop with a once-in-a-lifetime generational event, one truth will always be the same: buy the dip. So here's what I'm buying. Full disclosure, ever since I've started my YouTube channel and I started making more money, my investing strategy has sort of shifted away from passive dividend income strategies more towards a growth strategy, because I am making more money, which means paying more taxes, and getting paid dividends is a taxable event. So I want to minimize that as much as possible while I'm making some money. And if I see the opportunity to buy in at depreciated prices like we had this week, then I'm gonna buy some stocks, because my philosophy is, even though the stock market's a roller coaster, the only people that get hurt are the ones that get off halfway through, and I'm not about to get off. So that's why I bought 150 shares of Apple at $122.26 a share for a grand total of $18,339. Dollar cost averaging, done right. Not really, but I do love Apple, and since I don't have any shares in the EV market, I think I kind of fixed that. But this $2 trillion stimulus package that I do think we'll get will definitely pour its way into the stock market and into cryptocurrency. So if I have the cash to anticipate that event, then why not put it to work? So I'm gonna buy more stocks in this video. And even though it's tempting to get into high-flying ETFs like QQQ or ARK Invest, because Cathie Wood is the modern-day genius of our time, she got Tesla right, she gets Bitcoin, I'm still gonna stick to the one strategy that has proven itself throughout history to work time and time again, which is just to dollar cost average into VTI. And hopefully by the end of this year, I can bring this portfolio to $1 million. That is the goal. But after you're done watching this video, please go check out Ben Felix's video on chasing top fund managers, where he talks about these hedge fund managers that look like a genius when they're up, but when they fall a lot harder than the average stock market. And by the time most investors get in, their returns are nowhere near the expected previous rate of return. And since the expense ratios are so high, well, you're gonna pay a lot more money for it. So remember, always keep your expense ratios low. That is this number right here. Keep it low, keep it simple, keep it safe. Anyway, I bought 52 shares of VTI, which I will update my Patreon every time I dollar cost average every week or every month, and I'll keep everybody updated. And I bought specifically 52 because I just watched In and of Itself on Hulu by Derek Delgado. It's an incredible magic movie show. Definitely don't miss it. Don't forget to grab up to $250 worth of free Bitcoin using this link, blockfi.com/Andre, and then also grab 2 free stocks with Webull using the link down below. By depositing $100, you'll get 2 free stocks, each worth up to $1,850 each. And once you get them, make sure to track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday and Fridays, sometimes a Wednesday, and I'd really love to know your thoughts. And if you haven't already, go subscribe to the Millennial Money Podcast. It's with my friends Graham, Kevin, and Jeremy. It's a lot of fun. We post every Tuesday at 6 p.m. Pacific. Anyway, I'll see you soon. Bye-bye.